The OECD recently raised its US inflation forecast from 2.8 to 4.2%. That's not a small revision, that's a different economic reality. So I ran my system on the entire market, 4,000 stocks, to find which ones historically benefit most when inflation runs above 4%, and which ones get destruct. I found 7 winners and 5 losers. I'm showing you all of them, plus how to run the same screen yourself for free. My screen uses 3 filters. 1, revenue growth that accelerated during past high inflation periods, specifically 1973 to 74, 1979 to 80, and 2021 to 22. 2, pricing power, companies that raise prices faster than costs rose. 3, low debt to equity, because high inflation means higher interest rates, and leverage kills. You can set up identical filters on finviz.com. I'll show you exactly how at the end. 0 cost. The 7 inflation winners. I'll go fast. Save this video if you want to look them up later. Energy, Exxon and Chevron. Obvious, oil above 110 and they have near 0 net debt. They print money in this environment. Commodities, Freeport-McMoRan, copper. Every infrastructure bill and every EV needs copper, and supply is constrained. Inflation plus supply squeeze equals pricing power. Insurance, Progressive and Allstate. This one surprises people. Insurance companies reprice policies every 6 to 12 months. When costs rise, they raise premiums. Built-in inflation pass-through. Plus, they invest the float in higher-yielding bonds. Defense, Lockheed Martin. Government contracts have inflation escalators built in. Plus, the Iran war is increasing defense spending globally. Dual tailwind. Of course, whether any of these fit your portfolio depends entirely on your existing allocation and risk tolerance. Someone who's already 30% in energy doesn't need more Exxon. Now, the 5 that historically get crushed when inflation runs above 4%. Airlines, Delta and United, jet fuel is their biggest cost. They can't reprice tickets fast enough to keep up. In every high inflation period since 1970, airline margins compressed. Consumer discretionary, Starbucks. When groceries cost 15% more, the $7 latte is the first thing people cut. Real estate, Realty Inquan. High inflation means higher rates, which means higher mortgage costs, which crushes REITs. Their dividend yield looks attractive until you realize the share price is falling faster than the payout. Retail, Dollar General. Their entire business model depends on cost-conscious consumers. When wholesale costs spike, their razor-thin margins evaporate. The math doesn't work above 4% inflation. Whether you need to worry about any of these depends on your current holdings. If you don't own any of them, this might not affect you at all. You don't need my system to run this screen. Go to finviz.com/screener. Set the filters, sector, energy, materials, financials. Performance up over the past 3 months while the market is down. Debt to equity under 1. That's it. 3 clicks. Free, you'll get a similar list. My system adds historical inflation correlation analysis that Finviz can't do, but 80% of the work, you can do it yourself in 2 minutes. If you know someone who's sitting in all cash because they're scared of inflation, send them this. Cash is losing to inflation. At least now they know which direction to research. Subscribe. Every week I scan the market for signals that most people miss. Complete analysis. No cliffhangers.